Good evening. Good evening, Ma. Please let me know if you can hear me. Good evening. Please let me know if you can hear me.
Hi, I can hear you. Hi.
Oh, so excited to have you today.
Thanks. I'm excited to be here as well. Is this Bukumi?
This Ore,
Oh, all
book
right.
manager, yes.
I'm sorry, come again?
Yeah, Bookhub community manager.
Okay. It's very nice to meet
Yes,
you
and
as
you're
well.
so pretty.
Thank you so much.
Yes, so let me send a reminder to the group.
Okay. All right, I'll just be here. Uh, bu- bu- bu-
Good evening, everyone. I'd like to introduce myself. My name is Olu Ahmed, the community manager for Bookhub Africa. And then, like we all know, this is our third series on the financial 101. And then it's really been an amazing session of learning back to back for 3 weeks. And then right from Bolo, right from David Alade last week, and then our last speaker for the month. And then I know we have so much to learn today. So I'd advise you come with your questions, you get your notepad, you pay rapt attention. And then yes, just to address a quick issue. From next month, all our activities will be run based on subscription. That means for all activities that we're having, book reviews, our webinars, would only be accessed by subscribed members. So I like to say that if you're yet to pay your subscription fee, which is 5K for the whole year, please kindly do so, because our book for next month, I'm going to unveil tomorrow. Our book for next month, and we'll be having our fiscal review next month also. So please, if you know you're here to make your payments, please kindly make your payment and then send your details to me while I send you the details to join the community on Telegram. So please, I would like to invite our speaker to take over now. Thank you.
Thank you so much, Ore. Hello, Book Hub NJ. How's everyone doing? Just drop a reaction in the comment section. I just want to make this a lively session,
Sorry,
as
please,
well as
can you give me a minute? I think I skipped a part.
Okay,
So
go ahead.
give me a minute. Yeah, I skipped a part. So I'm so sorry. So our speaker for today our topic is assessing investment opportunities and different assets. So I'll be introducing our speaker to you, to everyone here. So please, while I introduce our speaker, kindly welcome her in the chat box. And then, so Mosunmola, the surname, is an electrical engineer by profession and is currently the president of an engineering consulting company based out of Atlanta, Georgia, United States of America. She's also the founder of the Finance Boost, a business with sole mission of empowering young professionals to start building wealth that will outlast their lifetime. Mosun has always had a strong affinity for the financial world, which led her to take up an internship during her undergraduate program with Goldman Sachs, a leading investment management firm. She also served as the financial secretary for the University of Lagos Engineering Society, ULES, a bachelor's program, and the finance officer of the African Graduate Student Connect during a master's program at the Georgia Institute of Technology. Beyond that experience, from the different finance-related roles she has been in, she has spent thousands of hours over the last 5 years studying personal finance topics to set up a financial system for ourselves that has helped her pay off debt in half the term, buying an investment property to generate passive income. She saved aggressively for multiple goals and built a 6-figure investment portfolio to propel her journey to reach financial independence early. Now she shares her knowledge with thousands through her Instagram page and her personal finance blog, thefinanceboost.com. She believes that while money may seem like it's all numbers accounting, your mind and emotions play a bigger role on how you think, feel, and behave with money. And that's where the learning and magic really happens. So please kindly welcome our speaker for today, Miss Mosunmola Solebo.
Thank you so much, Ore. Yes, you got the last name, it's Solebo. Thank you. It's really nice to meet everyone here. I always like to be among young individuals that are always looking to essentially grow personally and also like professionally. So I will be sharing my screen. Today's topic is understanding different financial assets and investments. So quickly, I just want to get a brief understanding of everyone that's in the room today. So can you just drop a 1 in the chat if you basically have a general understanding of what investing is, and you can just drop a 2 if you have no clue. Just give us a few seconds to do that. Okay, so I will proceed. Okay, I see lots of 1.5. All right, I get you. All right, so what exactly is investing? I know this word, especially in the last few years, has been thrown around. What is investing? Invest in this, invest in that. But I'll tell you what investing is and what exactly it's not. So first of all, investing is not a get-rich-quick game. So if you think that you're just going to pour a certain amount of money today and then tomorrow you're going to double it or triple it, then my friend, you're probably trying to, play Baba Jebo or just go to Las Vegas and throw in some bets. However, investing itself is when you're spending money, or in some cases, you're spending time on a particular venture with the expectation that it's going to appreciate in value. So now when it comes to the stock market or to companies or to assets, investing simply means that you expect that for X amount of money I put into this venture, I should receive some returns above my initial principal. So when it comes to investing in a company, for instance, you're simply buying into the ownership of that company. Say, for instance, I love Apple so much. I like their statements. I like their vision. And I believe that this is a company that, will move forward or appreciate in value in the future. Then I can say, okay, I want to become a part owner of Apple. And the way to do that will be to invest in shares of Apple. And that means I'm getting a share or a piece of Apple as an owner. So now, I believe we're all familiar with Amazon, the shopping e-commerce platform that you go buy, items online. So I'll also explain investing in those terms so that we can have something familiar to connect the two different entities. So investing in Amazon terms. So for instance, you may have heard of financial markets. In terms of Amazon, it refers to like an Amazon store. So the NASDAQ or the S&P 500, the financial markets in general, just think of it as Amazon store. And then we can relate asset classes themselves to store categories. So for instance, if I go to the Amazon website, I'll see home, I'll see kitchen. Sorry, I'm getting some feedback. Can everyone mute their mic?
Yeah, I did that already for the first
Okay.
time.
So I'll go to Amazon website and I'll see home, kitchen, sports. So that itself, the categories relate to asset classes. So these asset classes just classify the different groups of assets you can have. And we'll explain that in more detail over the course of the presentation. Also, we have assets. Now, these themselves are what you relate to the individual products. So under kitchen, you probably have kettles, you have blenders, you have plates and all of that. So these different assets are the individual investments in these classes, in the categories. And brokerages, it relates to like the different Amazon sellers. So for instance, on Amazon, it's a group of different people producing products and selling to the consumers. So with a brokerage essentially is like the middleman between you and the company that you're trying to buy their shares of, or between you and the, say, assets they're trying to get. Now, your portfolio essentially is your shopping carts. So you've gone through the Amazon store, you've picked your different assets, your products, and you've paid the broker for the different assets. Now your portfolio contains all these different assets, just like your shopping cart will contain all your products. So now, since we're talking about Amazon, the same way you're going to, evaluate different products, you do product reviews, you read comparisons, you compare Samsung TV to LG TV, check the specs and all of that. That's the same way you do research for individual companies or assets before you actually buy them as an investment. And meanwhile, remember, you're making an investment because you're anticipating a growth or appreciation in value. Okay, so now let's go into the different asset classes that we have. Now we've talked about how asset classes are the different categories that cover or that embody the different assets you can get. So the first one is stocks. Everyone or many of us are familiar with what stocks are. But to break it down further, it's buying an ownership in a company. So for instance, I said I like Google or I like Apple or Dangote. If I'm going to buy stocks in those companies, I'm essentially putting down my money to take in part ownership of that company or part ownership of Google in this example. Now, when it comes to bonds, which is another asset class, with bonds, you're actually lending out money. So bonds are like a debt instrument. Say Apple needs to grow, they need to expand, or Dangote needs to expand into the Asian region, or for some reason, they need funds to do this. So what they do is they'll issue out bonds to the public and say, hey, lend us X amount of money and we'll give you 2% interest in X amount of years. So with bonds, you're borrowing out money to either a company or a country. So in terms of a country like Nigeria, it will be in form of treasury bills or treasury bonds, to help the country, have money to develop its infrastructure, or a company. The next asset class is the commodities. Now, this refers to just common goods or physical goods like oil, which is Nigeria's biggest asset to date, or beef, meat, gold, just physical goods that are tangible. So for instance, if I'm believing that, okay, oil will keep on increasing in value over time because everyone, eventually uses oil in one shape or form, and I choose to invest in either barrels of oil physically, or I buy the paper form of my oil derivatives. So what that means is I'm investing in these commodities either directly by the physical assets or through paper assets that are tied to these different commodities. I've said a lot there, but we'll have opportunities to ask questions later. Now, another asset class is real estate. So this can be physical buildings like hotels or rental properties to rent out to become a landlord. Or you can also invest in real estate by investing in something called REIT. And that just means real estate investment trusts. So for instance, you may not have 70 million naira to buy a building in maybe Magodo, for instance. There might be bodies that have investments in several different properties, and then you buy into their portfolio, their real estate portfolio. So that's what REITs mean. Now, cash equivalents come in the form of certificate of deposits or high interest accounts. And these different investments have, very little returns on the investment because it's less risky. And the last one, which I deliberated whether to put this as an asset class, is cryptocurrencies. Cryptocurrencies, many of us may be familiar. You have Bitcoin, Ethereum, you have the ADA, Cardano, and the popular Dogecoin. So the reason why this has been recently classified as an asset class is because people do speculate on cryptocurrencies and expect them to appreciate in value. Okay, so that's a broad overview of what asset classes are. Now, we've talked about these asset classes and what they mean, but there's something called ETFs or mutual funds and index funds. Now, with those different stocks or bonds or commodities, you can buy them individually. So I can go straight to buy one Apple stock or 100 Apple stocks, or I can go to buy 100 shares of Google individually. But what these different funds do is that you're able to buy a bunch of different assets collectively in one pot. So I'll define what a fund is in general. The simple way to put it is that it's a pot of several different stocks or other assets grouped together from which you can buy as one bunch, essentially like a bundle. So now a fund might focus on a different sector of the economy or a different sector of, or a different country, for instance. You can have a fund that's focused on tech stocks only, or you can have a fund that's focused on only government bonds, or you can have a stock that's focused on all the stocks on the Nigerian Stock Exchange. So now for how it works, or how funds work, we're going to have an example. So I'm calling my pretend fund PTIX. So let's say I initiate this fund. I'm the fund manager, I'm the investment firm. And I create a fund where I buy Apple, Google, PayPal, Facebook, and Tesla, and I put it in my fund. And then I say that I have this portfolio on the left right here. So I have, say, this portfolio is worth $1 million, for instance. And all these different stocks are either rising or falling in value. So now let's say someone like Jackson sees my fund and is like, you know what, I'm probably going to buy PTX because it's had past proper performance, it has good returns. I like the investment manager. I think the investment manager, can get produce good return for my money. So Jackson says, okay, I want to buy $100 of your $1 million PTIX fund. So I, in turn, will issue Jackson $100 worth of PTIX. So now what that means is that if my fund goes up by 10%, which I'm the fund manager, then Jackson's investment will also increase by 10%. So his $100 becomes 110. However, it works vice versa as well. So if it goes down, then his portfolio also goes down. So now that's funds in general. It basically explains how you group different assets into one. Now, the different ETFs, mutual funds, and index funds, I'll explain how they differ from one another, because oftentimes it's used interchangeably and you may not know where one falls in another category. So with ETFs, an ETF essentially is an exchange traded fund. So that's the full name, that's the full meaning. And what that means is that it can be traded on an exchange. So for example, if I wanted to buy a share of Apple today, I go to my investment platform or my broker and I say, give me 10 stocks of Apple for maybe $1,000. Immediately my order gets fulfilled, right? I can get that order fulfilled instantly. So that's how an exchange traded fund works. So that fund, if I say I want to buy $100 worth of the PTIX ETF, I can buy it and receive it instantly during the trading window of the day. And also I can buy it fractionally. So for instance, let's say I'm issuing shares of my PTIX fund, which is the example fund I gave, at $100 per share. So let's say Ahis, for instance, is like, you know what, I don't have $100 to buy the PTX, but I want part of it, and I have $10. AEs will be able to buy $10 worth of that $100 share. That means he will have 10% of one share. So he'll have 1/10 of a share. So ETFs allow you to buy funds fractionally. And then they can be traded throughout the day. So as long as the trading window is open, the market is open, I can buy between 9:30 and 5 p.m. throughout Monday to Friday. And most ETFs will track indexes like the S&P 500 or the Nigerian All Shares Index. So what that means is that, first of all, an index is like a list of companies. So for instance, the Nigerian All Share Index, as an example, as an index, it tracks all the shares in the Nigerian stock market. So there's a list of all the shares in the Nigerian stock market, which I think is about 156. And then it collectively tracks their performance. So if the aggregate of their performance is that today the price increases, then the index will go higher. So now an ETF that tracks an index like that would only have the assets of that index in its fund. So most ETFs track indexes, while some are actually actively managed and selected by an investment manager. So, and that essentially makes most ETFs passive investments. So passive investments means that you're not actively checking the ticker prices of different stocks to decide, oh, EJ, like I think that's Apple will go up 10% tomorrow. I think that Google will go down 10% tomorrow. So it becomes a passive form of investment. Now with mutual funds, first of all, cannot be traded on an exchange. So I can't just go to my trading platform and say I want to get $100 worth of this mutual fund and expect to receive it immediately. No, a mutual fund cannot be traded that way, and it also cannot be bought fractionally. So I can't buy 1/10 of a share like I can do with ETFs. And for many of these mutual funds, they tend to have like a minimum amount of money that you can make as an investment in them. It also cannot be sold or bought, can only be bought or sold at the end of the day. So if I place my order, say 9:30 a.m. to buy a portion of a mutual fund, my order won't get fulfilled at that price that I'm looking at. It will get fulfilled at the end of the day after the closing bell. So once the day is over, then my order will be fulfilled. So if I was looking at the price at $5 in the morning and now it's $10, that's when my order will be placed. And also most mutual funds aim to beat the market. So you know how I said ETFs, most of them track the index. Mutual funds actually aim to outperform the general market. So a mutual fund manager is actively trying to pick the best stocks at any given time and sell the bad stocks at any given time. So there's always an activity going on, like every single day, buying and selling stocks or assets in a mutual fund. So, and that makes most mutual funds actively managed. Now, an index fund is very, very similar to a mutual fund, but the only difference is that all index funds must track an index. So you can't call this an index fund if it doesn't track a particular benchmark. So there are different indices, right? I talked about the Nigerian All Share Index. There's some that track just technology stocks. There's some indices that track just healthcare stocks and so forth. So an index fund must track a particular index. And that makes all index funds passive investments because that fund is barely doing anything. All it's doing is making sure that, okay, this is our index that we're copying. Just copy and paste that investment into our fund. That's what index funds do. So that explains the difference between all types of funds. Now, if you want to go to the Nigerian Stock Exchange to essentially see a list of the different ETFs or mutual funds or index funds available to you, you can go to ngxgroup.com, that's the Nigerian Stock Exchange financial institution. Now, portfolio diversification. So we've learned what assets are. We've learned how how you can either buy them individually or as part of a fund. Now, with portfolio diversification, these two big words just simply mean don't put all your eggs in one basket. So and that means that if I have $1,000 today and that's all I have to invest, I won't throw 100% of that into Bitcoin and be like, you know what, it's Bitcoin or I die, you know, to the moon or to hell. So with portfolio diversification, you have to make sure that you're spreading your risk across the different asset classes. So that way, even if, you know, one group is not performing well today or this season, the other group is performing maybe better, you know, in that same season. So your risk is essentially spread out. Now, this chart here is just showing like an example of diversification. So at the bottom here, I have stocks, bonds, commodities, and real estate, like we discussed under asset classes. And so this is an example. Within stocks, I have energy stocks, I have domestic stocks, I have tech stocks. Within real estate, I have residential buildings, I have vacation rentals, I have commercial buildings. So the point of this is to show you that you can diversify within a specific asset class, and you can also diversify across different asset classes. So this example is showing you that this sample portfolio has 60% of stocks, 15% of bonds, 5% of commodities, and 20% of real estate, and these different assets within the classes. Okay, now for asset allocation. Asset allocation is tied to portfolio diversification. Essentially, it's how you decide that, okay, I'm going to choose to put 20% of my money in this asset class, and I'll put 80% in another asset class. So you do this by figuring out your risk level and your time horizon. What that means is that for the risk level, if I feel that I buy an investment today, and if tomorrow it goes down 10%, I'm going to panic. I'm going to be like, you know what, we need to get out, we need to sell. I'm seeing red in my portfolio, I want to sell quickly. Then it means that I don't have much appetite for risk. And I'll tend towards more, less risky assets, like maybe bonds or certificate of deposits or something, less risky. Now, the time horizon determines, when do I need this money? When am I ready to pull out my investment from the market? If I have 10 years to invest, right, the way I'll invest my portfolio will be different from having, like 30 years to invest. So if I'm having much longer time between my investment period and when I intend to take out the money, then I might be willing to take on more risk because I'm giving my portfolio time to recover in the market. So this is that portfolio we saw in the past. So it's a sample of Jake's portfolio. He has 60% in stocks, 20% in bonds, 15% in real estate, and 5% in crypto, because he decided that, okay, this is how I feel about my risk level, and this is how much time I have to need my investment back. So I'm comfortable with this portfolio. That's essentially what asset allocation does. Okay, now we've talked about the very basics of investment, different assets. But there are some key terms everyone has to understand if you're going to be an investor. And that's because you want to make sure that you're not just following the herd, or you hear news today, the market is down, and then you panic, you don't know why. So these terms will help you understand why. First one is supply and demand. Supply itself essentially refers to sellers, when sellers are pushing into the market. So they're pushing a lot of items or stocks or goods into the market. Whereas on the demand side is the buyers that are pulling from the market. So you have these two different groups. So when you have more sellers than you have buyers, then it means that the sellers have to drop their prices so that the buyers can buy from them. So in that case, sellers more than buyers means prices go down. But if you have more buyers than sellers, then it means that there are more people chasing a limited amount of goods. So more buyers chasing less goods will cause the price to increase. The next thing to understand is inflation. So inflation essentially means that the prices of goods are rising. So for instance, if milk was 5 naira today, and in 3 months' time, milk is 10 naira, then that essentially is a classical example of inflation. And one thing that struck out to me was that Nigeria's annual inflation rates, just as at last year, December, was at 15.6%. So that means if I had 10,000 naira sitting in my bank account from January of 2021, at the end of the year, what that means is that my 10,000 naira essentially is now worth 8,500 naira. So that's what inflation does. It decreases the value of your money. So at that point, you end up losing money, because if something was, so for instance, this is another example, a crate of egg was 900 naira in 2021. And then in beginning of 2022, it became 1,300 naira. So if I had my budget at 900 naira to buy eggs every month, and now it's 1,300 naira, it means I'm broke, essentially, because if there was no more room for in my budget for expansion, then I'm basically broke because I can't afford 1,300 naira worth of eggs. So inflation does that to your money. It basically breaks down the value of the cash you have. And it's why people tend to take their money and put it into assets that will yield value, because otherwise in a bank account, you're losing money. Next thing is bond yields. Now, bond yields directly tied to bonds, and it basically means the returns you earn on the investment you make in a bond. So I mentioned before, Nigeria wants to issue bonds, and they're like, you get 5%, or you get 10% for every maybe 3 years that you invest or you buy bonds, right? So a classic example of that is, if I buy 100,000 naira worth of treasury bonds, and that treasury bond has a yield of 5%, I want you to take note of that word yield, because we'll use it eventually later on. If that's a yield of 5%, what that means is that my investment will pay me 5,000 naira yearly in returns until the maturity date. Okay, so a bond yield tells you the returns you're going to get on a bond investment. All right. The next thing are dividends. So remember, you're buying a stock in a company makes you a part owner of that company. Same thing when it comes to them sharing out profits. So now, because you're an owner in a company through your stock shares, where at the end of the year, when it's time to share profits, you get a portion of the company's profits in dividends. So that's what dividends are. It's just sharing of profits by a company. Now, keep in mind that not all companies pay out dividends, and not all of them actually, and the dividends may vary, the percentage may vary. And that's because some companies are focused on growth. So every profit they get, they reinvest into the company. While others are established, like Coca-Cola, where it's like they've made this money, they want to appreciate their investors, so they pay out dividends, on a regular basis. An example, say you have 100 shares of Coca-Cola, for instance. Now, and Coca-Cola is like, you know what? Our dividend per share is 42 cents, which actually is right now, 42 cents. What that means is, as an owner of 100 shares of Coca-Cola, I will get $42 in quarterly dividends. So every quarter, I'll get $42 on my 100 shares of Coca-Cola. So that's what dividends do. And this is separate from the actual returns that your investment is, making. The next thing to understand is dividend reinvestment, and it's quite straightforward. It's essentially you taking the $42 that Coke gave you as dividends and putting it back into buying more Coke shares. So you're basically reinvesting your dividends into the company. So now what that does for you, you're essentially expanding how much returns you can make from your initial investment. And I'll explain that with the next term to know, the compounding power. So now this essentially talks about how your money earns money on money on money. So if you had any economics class or math class and you talked about compound interest or the compounding formula, what that means is that, say, for instance, my original investment is 50,000 naira, and my return on that investment, say it's 5,000 naira. So meanwhile, my investment is still with, in the company or in the bond. What that means is that through the power of compounding, if I leave this return and not take out my profits, the next return calculation on my total investment will now be calculated not on $50,000, 50,000 naira, but it will be calculated on 55,000 naira. So that's compounding. Essentially, you start earning returns on your original principal in addition to returns on your returns. So that plays into dividend reinvestment as well. It gives your money more power and more room to grow, exponentially over time. So keep in mind these 6 things. We're going to do like a practical exercise to basically understand and digest these different terms. So now, this is an actual excerpt from the Vanguard article on January 3rd of this year. So we're just going to run through some statements in there on the economy or investments and try to put everything we've learned together to see why some things happen in the market. So let's start by saying the all share index, which is the Nigerian index that tracks all the stocks in Nigeria. So it rose by 6% in 2020 it rose by 6.07% in 2020. So now it says that the ASI, which is an all share index, is a major performance benchmark. So a major performance benchmark because since it contains all the stocks of the Nigerian market, then they're moving in tandem. If the index goes up, then it means that the economy is doing well or the market is doing well. If it goes down, then the whole thing is not doing well. So it talks about the health of the overall stock market. That's this index in particular. If this was replaced with the I'll use the S&P 500. The S&P 500 is a US index that tracks the top 500 stocks in the US. So if this was replaced with the US S&P 500, then it means that this is a major performance benchmark for those 500 companies only. Now, it goes on to say that the ASI gained 50% in total in 2020. So that means at the beginning of 2020 to the end of 2020, all the shares, not all the shares, but like the cumulative effect of the shares rose by 50%. Now, however, something started to happen in January of 2021. Equities started to decelerate. Now, equities also refers to stocks, essentially. Equities and stocks are they're synonyms. So equities started to decelerate because of rising yield on fixed income securities. So remember I said to keep in mind the term yield. So I said bonds are much less risky investments. So in our previous example, I told you that you get a fixed interest on your bond investment. So if I tell you that, okay, this fixed investment is going to yield 10%, right? And it's less risky. But then you can choose to go to the stock market and you might potentially get 10% or less. You most likely tend towards the bond, which is safer and has a higher, higher return. So equities accelerated because yields started to rise, right? So that's what happened in this instance. Stocks started to fall because bonds became more attractive to investors. Now, we'll go another step further. Now, at the end of the first half of 2021, which was last year, the stocks had slumped 11%. So the ASI, which tracks all the shares of the Nigerian market, slumped 11%. And this is also, continued from the previous slide we saw where, the yield started to rise, so the stock started to fall. Now, this first statement tells us why the stocks even rose 50% in the first place in 2020. It says that there was expansionary monetary policy. And if you remember in 2020, that was when COVID was happening, the economy was tumbling, things were crashing. So the government in that time created policies that will help drive growth in the economy. So when there's growth in the economy, people tend to take their money to invest in assets that are likely to capitalize on that growth. So that's essentially what happened in the first place. That's why you had a 50% rise in the stock market. So, but as that rise was happening in the stock market, the yields were driven to low single digits. So the yields fell because now stocks are more attractive. Fine, you have yields now at maybe 5%, but stocks have the potential to get to 50%. I'm taking my money out of the bond market and I'm putting it in the stock market. So there's that balance, or there's that, zigzag between the bond market and the equities markets because of the return level and the return potential that you can get. And so, but when the yields started to rise again, financial assets retreated back to fixed income securities. So it was just like a game of hide and seek. As yields go up, stocks go down. As stocks go down, yields go up. And all of this is happening because people are constantly, or investors that understand the market, are constantly trying to make sure that their money is not affected by the huge inflation that's happening, especially in Nigeria. Because if I have my money just sitting in the bank, it's going to be drained 15% at the end of the year, at least in the case of 2021. So that was just a simple exercise or a practical application of everything we've learned, just so that you have, a better understanding of how to tie investments, stocks, bonds, and the financial markets, especially in the media, so that tomorrow when they say, oh, stocks are crashing, you're not just moving with the herd or being having FOMO or fear of missing out, wondering, should I buy? They said I should buy. Should I sell? They said I should sell. You have a more clear perspective, and you can research on your own and see what's happening. Is this a short-term effect, or is this going to be long-term? So this can actually help you have that insight by yourself. Now, we've talked about Nigeria, investing in Nigeria. We've talked about the level of inflation in Nigeria, especially with the exchange rates going higher and higher, and it looks like there's no end to it. So if you want to invest in Nigerian stock market, I told you the website to go to, which is the Nigerian Stock Exchange website, where you can see the different stocks or different ETFs or index funds. However, if you want to invest internationally, because I get questions, how do I invest in US stocks from Nigeria, or how do I invest in ETFs from Nigeria? Because I don't want to invest in Dangote that will probably not yield anything. And besides, you're investing with your Naira that's already being tackled by inflation. So due to the rise of fintech in Nigeria, there have been some nice platforms that have been developed that actually gives you an exposure or access to the US market or the international market from Nigeria. So Trove, Bamboo, and Chaka, these are three of those platforms that allow you to buy US stocks, buy US ETFs right from your phone in Nigeria. So the point is, these are new platforms. So you definitely have to do your own research in terms of finding out their trustworthiness. There's not much data right now because they're probably like 2 to 3 years old. There's not much data to see, their trustworthiness. But majority of them are, or all of them are registered with the SEC. The Exchange Commission's body in Nigeria that requires brokerages to register with them before opening up a platform to the public. Now, Rise itself is more of a mutual fund. It's in Nigeria, but they choose the stocks and ETFs to invest in. So for instance, remember how I talked about mutual funds as an investment body being in charge of choosing the different assets. So Rise has, I think, a portfolio of about 30 US ETFs and stocks that they've handpicked themselves. And if you want to invest with Rise Vest, I believe that's what it's called, then you have to invest in their mutual fund. So these are the 4 different platforms I found that can help Nigerians basically capitalize on the international financial markets. So now this is Bookhub. So it's a community where you are all learning and expanding your knowledge through books. So I will be remiss if I do not give some book recommendations on personal finance and investments. This here is my personal favorite. I Will Teach You to Be Rich by Ramit Sethi. So this book helps you plan and strategize or set up systems to build your wealth. And it also points your attention towards your different money biases you may have because you grew up with parents or people that didn't really know about money. You've developed some bad habits about money. So this book actually helps you, guides you through planning for your money and setting up systems to expand and grow your wealth. Broke Millennial is by Erin Lowry. It gives you practical personal finance tips. And it's also very akin to young adults, how adulting is, adulting and money, how to pay off debts and the likes. And then The Psychology of Money, it's a book not for teaching you how to save or how to make money, but instead it relates or ties your behavior and your biases and your different environmental influences to how you react to money. So it talks more on the psychology of money, on how things are not just black and white, on how 10 naira plus 10 naira equals 20 naira, but it doesn't mean that you act based on that knowledge. Okay, so these 3 books are really good books, just for general personal finance knowledge. And then you have some books on investing. If you follow me on Instagram, I'm always talking about my preferred investing method, which is through index investing or ETF investing. And so I'm a little bit biased with the books I picked. So books on investing, you have The Simple Path to Wealth. And this is more focused on you helping you retire early. So they'll teach you things like invest 50% of your income at this point in time in index funds, so that you can basically quit the workforce earlier if you choose to. And then the Little Book of Common Sense Investing by John Bogle. John Bogle is actually the founder of Vanguard in the US, which they're an investment platform that created one of the first ETFs and index funds. So this book actually gives you a guide on how to invest in index funds and ETFs at a very low cost. And then the last one is by our very own Nigerian, Bola Shokunbi. It's called Learn How Investing Works and Grow Your Money. So it gives you like the basic foundation on investing, how to start investing, if you're very good to investing and you don't know where to start from. Okay, so it has been my pleasure with Bookhub this morning. And I am very, very grateful for the opportunity. I spoke to Bukumi and Ore, and you have a very, very lovely community, and I really appreciate the opportunity. So I'm ready to take any questions you might have, and thank you.
Thank you so much, Mosun. Thank you so much. It was indeed an amazing session. Like these things, I know about them, but then you broke them down into smaller bits and then very relatable. Thank you so much. It was indeed a great session. So I'd like to take your questions. If you have questions, you can please write them in the chat box. And then if you would like to talk, you can just please raise your hand and then unmute. It was indeed an amazing session. Thank you so much. Thank you for your time. Thank you for spilling a lot of wisdom today. Thank you so much. I really learned a lot. Just followed you on IG. Thank you so much. That's all I can really say. So if you have questions, write them down while I read them out. Please drop your questions. If you like to talk, you can raise your hand and then you'll unmute. Yeah, someone is saying, thank you, Mosu. It was insightful. Yes, it was really insightful. You're a very great teacher. I must say that.
Thank you very much. Thank you very, very much.
So please, you can drop your questions if you have questions for Mosu. Yes, the slides are so simple. Thank you so much. Thank you. I really learned a lot, and then I have to go back to these slides again and then go through your Instagram page. There are a lot of nuggets to follow. So I think we have something to say.
What do you want? Move your shoe now.
I'm so sorry.
Can you mute?
So sorry.
Okay, so we have the question, and then I'll read the question out. It says, that someone said, I want to ask, at what point do you know that it is best I start investing now? Is there a time frame?
All right, yes. So I always say the best time to invest is, today. The earlier you start, the more time you have for investments to grow. However, I would not start investing unless some basics and fundamentals are taken care of. So for instance, you have to have saved up, like emergency amount of money. So you want to save up some stash of money, because with investing your money, there's risk involved. And with investing, there's also like timelines. So you cannot start investing in the market if your financial fundamentals are not set up right. And so if you start working today and you're making some money, and you started saving some money on the side for when maybe a financial crisis happens, you never know when you might have to maybe pay for something you never planned to pay for. Once you have that aside and you don't have any ridiculously high interest debts, then please put in as much money as you can in the stock market or in investments. So there's no time, is essentially like a age to start. You can start, in fact, you can open up investment accounts for newborn babies. So as long as your financial fundamentals are set up right, then please just start investing. There's no point keeping your money under your bed or your socks or in the bank account.
Thank you so much, Mosu. I hope that answered your question. So I think we have 2 other questions here. So Victory, I am so sorry. I really did not see that. My question is, how will you know variable stocks? For example, for instance, when people say, if you had invested in Netflix 10 years ago, you'd have made $300,000 by now. So she's saying here that, for example, I hear people say they invested in Netflix 10 years ago and the returns has been so high. So that's one question from Victory. Would you like me to read through the questions, or then we take them one after?
I can actually see them. I can see them myself. So I'll take Victory's question first. So yes, of course, people will tell you the ones they invested in that paid out, right? In terms of which stock to invest in, or how do you know, okay, this is the viable stock to invest in? First of all, except you are a full-time stock investor, stock trader, or you're a full-time investment manager, you don't have that time or resources to be able to research thousands of stocks and say, okay, this one is going to be the winner in the next 10 years. So the best way to do that is to do that through funds. So if you're investing in a diverse classification of stocks already through an ETF or an index fund, then that way you're not just picking one stock to ride the tide. You're investing in a basket of several stocks. So, and that's the route I always go, and that's the route I always preach to people. Go to an ETF if you like technology, but you don't know which of these companies will make it through the next year. just decide, okay, I'm going to go and invest in a technology ETF or a technology index fund. So that way you're buying across the broad market of that particular sector. I hope that answers the question. If not, you can just drop in another clarification question and I'll take it. So
Thank
the
you,
next,
Mosun.
all right,
I
you can
think
read your.
Victory. Yeah, Victory, did that answer your question? Please let me know in the chat box. So I think we have one more question here. So from Samuel Hakiwale, it said, thank you, Mosun. It was an interesting class. Yes, it was an interesting one. You mentioned a couple of Nigerian brokers like Bamboo, Tro, VTC. Are there any non-Nigerian ones you could suggest?
Yes, so there are a few ones that actually help you invest in, internationally. Interactive brokers, I think, gives access to international investments to like maybe 100 and something different countries. Interactive brokers, and then there's First Trade. First Trade also allows you to invest from whatever country. Now, whether Nigeria is on that list, I cannot say for certain, but I know that those are international brokers. Other than that, there are some brokerages that are more towards the active trader. So for instance, I think it's eToro, but these ones tend to have fees. So if you're someone that's trying to invest on the long term, some of these brokers have inactivity fees. So if you buy an investment today, you're like, okay, I'm going to keep it for 10 years. They will start charging you monthly because you're not active. So you also have to consider the costs of these different brokers. So, yeah.
I think that's all because I can't find any other question here. You've answered Victory's 2 questions. So please, if you would like to say anything, if you have any question, Victory, your hand is still up. Would you like to say anything? Hi, Victory.
Hello, no, my question has actually been answered.
Okay.
Yeah.
Thank you so much, Mosun. I really learned a lot. It was indeed an amazing session. And we look forward to inviting you again. We look forward to having you again. Thank you so much, Mosun. Thank you so much. Thank you, Bukumi. Bukumi, do you have anything to say?
No, I don't.
Okay. Thank you, everyone, for joining. Thank you, everyone, for joining. For those who joined late, I made mention that from next month, that's from February, all our activities will be run based on subscription. That's our book reviews, our fiscal reviews, and then our webinars. People who, as our subscribed members, would have access to these activities alone. So if you know you're here to pay for your yearly subscription, which is 5,000 Naira for 1 year, please kindly make payments. We would not like to miss anyone, and they would not like to leave anyone behind. It's really been an amazing time learning together.
Hi,
Okay,
yes, so sorry. I just want to say thank you, Mosun, for honoring the invite. I sure like it was a very robust session, like very deep. I think would like to have the slides if you don't mind. So we can actually go over some of these lessons again. I don't know, I think some other guys also share that sentiment. Like there are a lot of stuff that we need to actually go over again. But I sure did enjoy myself and I learned like more about, I liked the Amazon, I liked the example you did with the Amazon thing. Like you gave it more perspective. So I don't know. After this session, you can probably share your slides. Would like to have it. But thank you all. Thank you so much for honoring this invite. Thank you so much.
Thanks, Buko. I'll email. I'll email the slides to Bukumi. Thank you.
thank you so much, Mosin. It was really a great time learning from you. Thank you so much. Thank you so much. Thank you. Thank you guys for showing up. Thank you for coming through. We look forward to seeing you very soon again next week. So bye.
Bye, Ori.
Bye.
Bye, everyone. Have a nice weekend.
Yeah, bye everyone.